with us is Ned Naylor-Leyland. He's an investment director at Cheviot Asset Management, where he advises a specialist precious metals fund. Ned, thank you for joining us today on the program. There was a lot of concern that actually gold would be hit with a lot of volatility as investors constantly change their positions depending on the strength they see in the equities market. Can it touch 2000? This is the kind of, the ultimate, I guess, goal that investors want to know. And if it does, are we going to see a lot more volatility?
Well, I think we're probably likely to see volatility one way or the other, Francine. I think that 2000 is going to happen at some point, probably in the relatively near future. And volatility is what we've seen all the way through the year. I mean, we're up 25% despite some big moves in both directions. I suppose the issue is more what's driving the market and what will win. I see the gold market as being something of an earthquake zone at the moment. You've got very powerful forces in both directions.
So what, fundamentals?
Yeah, fundamentals in terms of the physical buying, particularly in the Eurozone at the moment, a lot of Eurozone buying, and a lot of...
This, sorry, Ned, is coming from what, central banks, or who's actually buying the...
Well, central banks
is this like a protection, basically, and saying, well, at least I have a tangible asset, where the asset fund can't completely dissolve if the Eurozone were to split up?
That's right. I think, well, some central banks have been buyers. I would argue that some central banks aren't buyers, though. Some central banks are working in a way like they used to in the 1960s in the London gold pool back then, which is effectively to make their currencies look better by loaning, leasing and swapping gold into the market. So I see this as being a very interesting time because you've got these two opposing forces, one which is genuine physical demand and demand for delivery of metals as well, which is a big change. And then you also have the leasing and swapping side on the other side.
In terms of what we can see, though, if we're going to hit a recession, not only in Europe but worldwide, of course, that fundamental, or the fundamentals will be hit. Will the other side of the equation be able to keep prices at these levels, or will we actually still see central banks buying because actually, if we're in a recession, we have no idea what's going on in the markets?
Well, the global marketplace argument is one about commodity demand. And I would argue that gold and even silver are really monetary and currencies, really. Yes. So for that reason, I don't see that as being a problem. In fact, I would see that as being further bullish demand for the metals going forwards. I think the interesting thing is that asset managers generally are still quite underweight the sector relative to where I think they probably ought to be to protect their clients properly. So I would see that tending to feed in over the next 12 months.
But now, talk to me about prices. I mean, are we going to see a range of between, what, 1,600 and 1,800 for the next 6 months, and then is it going to hit the 2,000 level? Is it difficult to predict?
Well, of course it's very difficult to predict, and it's a currency. So I would say, unless you have short-term targets of euro-dollar or any other cross rate you might want to look at, I would be a bit cautious about trying to be too clever with the timing. I think more important is, are you invested? If you have none, I would tend to suggest that being too price-specific is probably the wrong approach. But if you're already well invested and wanting to add, then yes, buy the dips and look to accumulate and make the most of the volatility, which I'm sure will remain.
All right, Ned, thank you so much for your advice. Ned Naylor-Leyland, their investment director at Cheviot Asset Management.